Dear students, we will do module 91. This is deductions from gross total income, section 80D and 80DD, part 1. Part 2 is also there. You have to remember, part 2 we will be doing the problems and part 1 we will be explaining the theory. So, section 80D. 80D, whenever you think about 80D, you have to remember that it's for medical insurance. This deduction is available for premium paid, medical insurance premium paid, or preventive health checkup. That is very common. Everybody will go for preventive health checkup. And contribution made to the central government health scheme. Short form is CGHS. Now, what are the conditions for claiming section 80D deduction? First one is, it is allowed only to individuals and HUFs, Hindu undivided families. So, it is important you have to remember, some sections they are allowing only to individuals, some they are allowing to individuals and Hindu undivided families. Now, donation is available for everyone. So, like that, each section has its own distinct features. Now, health insurance premium should be paid during the relevant previous year. So that is also important. Then only you can compute for computation. Then only you can consider for computation. The premium should be paid out of income chargeable to tax. If you are paying out of exempted income like agricultural income, you cannot claim this deduction. It has to be paid by any mode other than cash. Always you remember, if the premium is paid by cash, you are not eligible. Now this deduction is allowed only under the old tax scheme. Now, diagrammatic representation of 80D, two divisions are there. One is for individual and one is for parents. This is very important. One is for individuals and one is for parents. Now, individuals, self, spouse and dependent children. Individuals, self, spouse and dependent children. That is very important. Dependent children. Now, you have to remember, now for individual, you have to remember, medical insurance policy paid for GIC or any other health scheme approved by the central government or IRDA, Insurance Regulatory Development Authority. Then contribution to central government health scheme, that is also eligible. Then preventive health checkup. Preventive health checkup, you have to remember, the premium can be paid in cash also. For parents, two deductions are allowed. One is medical insurance scheme of GIC, General Insurance Corporation, or other health schemes approved by the central government and IRDA or IRDA, Insurance Regulatory Development Authority. Then preventive health checkup also is possible. Now, eligibility, medical insurance policies of individual, spouse and dependent children, and contributions made to central health government schemes. The least of the two shall be allowed. Actual premium paid or rupees 25,000, and in the case of senior citizens it can go up to 50,000. Senior citizen meaning above 60 years of age. Now, medical insurance policy for parents. Always the least of the two amounts. One is the amount paid in premium paid or 25,000 if it's below 60 years of age. If it's above 60 years of age, that will go up to 50,000. Now, if senior citizen parent does not have health insurance, a deduction can be claimed for actual medical expenses up to rupees 50,000. Then deduction up to rupees 5,000 is allowed for preventive health checkup within the overall limit. Within the 50,000 or 25,000, this preventive health checkup 5,000 can also be included. That amount can be paid in cash also. Preventive health checkup expenses can be paid in cash, whereas all other premiums should be paid by check or any other mode of payment other than cash. Maximum deduction under the scheme can go up to rupees 1 lakh, where both the taxpayer and family and parents are senior citizens. Now, example, spouse and children. Imagine if an individual age 45 years, he is paying 22,000. Then he is eligible for 22,000 because if he is not below 60 years of age, up to 25,000 he can claim. Paid for senior citizen parents 40,000. This limit can go up to 40,000. So total he can claim 62,000. This is the explanation. Now, maximum deduction, if is an individual is a senior citizen, 50,000. His parents are also senior citizens, then this limit can go up to 1 lakh. 1 lakh. Now, Section 80DD. This is maintenance including medical treatment of a dependent person. Dependent person physically challenged or some deadly diseases. So this deduction is allowed to resident individuals. Here the term is important, resident individuals and Hindu undivided families. Allowed only as per the old tax scheme, and this deduction is allowed for expenses incurred on the maintenance including the medical treatment of a dependent who is a person with disability. It can be children, it can be dependent, brother, sister, anybody, parents. This is fixed deduction that and not related to actual expenses spent. See, whatever the amount, it's a fixed expense. You don't have to show the actual expenses. Medical certificate from the prescribed medical authority is required to prove the disability. Now, meaning of dependent for an individual: spouse, children, parents, brothers, or sisters who are dependent on the taxpayer. Now, conditions for claiming deduction under Section 80DD: spends money for medical treatment, training, or rehabilitation of the dependent with a disability, or pays or deposit under a scheme for maintenance of the dependent with a disability. For example, with LIC or the Administrator of Unit Trust of India or other approved schemes. The dependent should not claim a deduction under Section 80U of the Income Tax Act 1961, because you know that 80U is also for disability. But our Income Tax Act is very clear: one expense or one income, only in one place only you can claim. There is no double claiming, whether it is an income or an expense. So if you are claiming here, then you cannot claim under Section 80D. Now, deduction allowed based on the type of disability. If disability is up to 40% or more, you know that the doctor has to give the certificate for that. The fixed amount is allowed 75,000. There is no need to match with the actual expenses. Whether he will spend or not, whether he is not spending or not, he can claim 75,000. Severe disability, that is 80% or more, he is eligible for 1,25,000. So this is what I wanted to explain in this module. So I am giving you the theoretical concepts. Next module we are doing the problems. Thank you. Happy learning.